Good morning. As of 11:28 a.m. IST on Wednesday, October 22nd, 2025, the U.S. markets, including the NASDAQ, are currently closed. We are therefore looking at the closing figures from yesterday's session, October 21st, 2025, for Krispy Kreme, ticker DNU. The stock finished the day at $3.71 per share. That was a massive surge, closing up $0.45 or 13.80% in a single session. Now, the immediate expectation when you see a double-digit pop like that, especially for a stock that has been so thoroughly beaten down, is that there must be some profound positive news. Maybe they announced a new national partner. Maybe they reversed the decision on the disastrous McDonald's experiment. Maybe they shocked the world with a blowout earnings forecast. The reality, however, is far stranger and, for long-term holders, perhaps far more worrying. This 13.80% surge appears to have almost nothing to do with Krispy Kreme's actual business operations. Instead, it was ignited by a bizarre and completely unexpected headline. Yesterday, during congressional testimony, Federal Bureau of Investigation Director Kash Patel, of all people, was questioned about his personal financial disclosures and happened to mention his personal stake in Krispy Kreme, stating he simply saw it as a good investment. The market, which is starving for any narrative, grabbed onto this. Within minutes, retail message boards lit up, volume exploded, and the stock was off to the races. This wasn't a fundamental re-rating. This was a sentiment-driven ignition. Welcome to the 2025 meme stock cohort, where Krispy Kreme, much to the dismay of its long-term investors, now finds itself mentioned alongside names like Kohl's and GoPro. This 13.80% jump is the market reality of what happens when a stock has fundamentals this broken and short interest this high. It becomes a technical trading vehicle, completely detached from whether they sell more donuts or not. To really understand what's happening, you have to look at the tension between this sudden speculative rally and the crushing weight of the company's actual performance. This stock is not just down, it has been decimated over the last year, falling from a 52-week high of over $12.60 to a 52-week low of $2.50. The $3.71 price, even after yesterday's rally, is still catastrophically low. The reason for this collapse is what makes yesterday's move so suspect. The entire bull case for Krispy Kreme, the narrative that took it public again, was built on its hub and spoke model. The idea was to leverage their kitchens, hubs, to deliver fresh donuts daily, DFD, to thousands of new points of access, primarily grocery stores and, most importantly, a massive phased national rollout with McDonald's. That McDonald's partnership was the thesis. It was supposed to be the growth engine for the next decade. And on June 24th, 2025, that entire thesis officially failed. The company announced that it and McDonald's USA had reached a joint decision to end the partnership. The market was stunned, but the real damage wasn't revealed until the second quarter earnings report on August 7th. That report was one of the most disastrous in recent memory for a consumer brand. Krispy Kreme posted a GAAP net loss of $441.1 million. To put that in perspective, their net loss in the same quarter of the prior year was only $4.9 million. Where did that $441 million loss come from? A staggering $406.9 million non-cash goodwill and other asset impairment charge. In plain English, the company had to officially admit to the market that the assets associated with its growth plan, specifically the DFD model intended for partners like McDonald's, were essentially worthless. The CEO, Josh Charlesworth, had to state it plainly. Our results for the second quarter primarily reflect the impact of unsustainable operating costs relative to unit demand in the McDonald's USA partnership, which ended July 2nd. This wasn't just a pivot, it was a public admission that the core strategy had imploded. The company had spent hundreds of millions building out a supply chain for a partner that it couldn't service profitably. This Q2 disaster followed an already terrible Q1 report on May 8th, where the company missed on both revenue and earnings per share, posting a negative 0.05 EPS when analysts were looking for negative 0.04. The stock plunged 28% in the pre-market on that news. Critically, in that Q1 report, management withdrew its full-year outlook, citing ongoing uncertainties. Those uncertainties became crystal clear when the McDonald's deal was officially terminated a month later. So the company that exists today is one that is officially in turnaround mode, as they called it in the Q2 release. They are quickly removing costs tied to the failed partnership and trying to find other high-volume doors. This is the fundamental backdrop: a company with no guidance, a failed primary strategy, and a $406 million hole in its balance sheet. This is why the stock was trading near $3. This is why self-investing in this name has been so painful. It's not a story you'd find in a brochure for Schwab Intelligent Portfolios or recommend as a stable holding in a Fidelity brokerage account. It's a broken growth story. And that is precisely why it's a meme stock. When a company's fundamentals are this bad, it attracts an enormous amount of short sellers. Traders who are betting the stock will go to zero. They see the $441 million loss, the cash burn of $32.5 million in operating activities, and the end of the McDonald's deal, and they smell blood. They borrow shares, often using platforms like interactive brokers that cater to sophisticated trading, and sell them, hoping to buy them back later at $2 or $1. The most recent data from the end of September 2025 shows that Krispy Kreme's short interest as a percentage of its float was over 30%. That is an astronomically high number. For comparison, a healthy blue chip stock like Apple stock might have short interest under 1 to 2%. Even a volatile name like Tesla stock often sits in the 3 to 4%. 30% means that for every 10 shares available to trade, 3 are held by someone betting it will crash. This creates a tinderbox. All it takes is one spark. Yesterday, that spark was the FBI director's offhand comment. Suddenly, retail traders, many using accessible online investing apps like Robinhood or SoFi Invest, see the headline. They see the 30% short interest, and they see an opportunity for a short squeeze. They all pile in at once, buying shares. This sudden demand forces the stock price up. The short sellers, who are now losing significant amounts on their bets, get margin calls. Their brokers force them to cover their position, which means they must buy back the shares they borrowed at any price to return them. This forced buying from the shorts, combined with the buying from the Robinhood stock trading crowd, creates a feedback loop, launching the stock 13.80% in a day on no actual news. This is the reality of yesterday's move. It was a technical battle, not a fundamental recovery. This volatility is a trader's dream and a long-term investor's nightmare. So, who is on what side of this trade? The institutional ownership data from mid-2025 filings paints a picture of extreme confusion and division. On one hand, you have the big long-term stewards of capital, the kind of funds that underpin Fidelity mutual funds or Fidelity ETFs, running for the exits. The Vanguard Group, as of June 30th, decreased its position by a massive 1.9 million shares, a 21.47% reduction in their stake. stock. BlackRock and Geode Capital also reduced their positions. The Fidelity Small Cap Index Fund, FSSNX, has been trimming its exposure. These are the Fidelity Wealth Management types, the investment helpers who see the $406 million write-down and the withdrawn guidance and want no part of it. But on the other hand, you have the hedge funds. Millennium Management, a massive multi-strategy fund, increased its position by 160%, adding 3.36 million shares. Morgan Stanley also significantly added to its stake. This isn't because they believe in the long-term donut strategy. It's because they too are playing the volatility. They are using their sophisticated interactive brokers trading platforms to trade this stock like a hot potato, scalping profits from the squeezes and dips. This leaves the individual investor, the self-investing person looking at investing sites for ideas, caught in the middle of a war between hedge funds and short sellers. Wall Street analysts, for their part, are completely paralyzed by this. They are stuck between the awful fundamentals and the explosive meme potential. Of the 8 analysts covering the stock, the consensus is a hold. There is